Well, kia ora, and welcome to the kaka to Paul Conway, the Chief Economist for the Reserve Bank of New Zealand. Te putia matua. Paul, great to see you.
Tanakwe, Bernard. Thank you. Nice to see you too, as always.
Yeah, so we're speaking a couple of days after the Reserve Bank cut the official cash rate by 50 basis points to 4.25%. Why did the Reserve Bank cut again by 50 basis points?
Essentially because the Monetary Policy Committee is confident that inflation pressures in New Zealand are easing to the point that we can get on with our easing cycle. So it's the second 50 basis point cut in a row after kicking it off with a 25. So we've done 125 points so far, taking the OCR from 5.5% to 4.25%. And we can get into the dynamics of inflation that's sort of given us the confidence to do that. It's kind of, headline inflation is pretty much at the midpoint of the target range. Economic growth in New Zealand is projected to increase slowly but surely, and interest rates are coming down, which is a nice way to end the year.
Yeah, so the question for everyone, both on inflation and on interest rates, is are we there yet? And on the inflation front, we seem to be there. So we're in the sort of middle of the band. Dumb question. Why not just cut the official cash rate all the way to neutral, so to speak? Take your foot off the accelerator and just sort of take it to idle immediately rather than in a series of points, because neutral around about 3% from the charts I was looking at.
Yeah, more or less. We kind of think of it as a band, 2.5% to 3%. Not a dumb question at all. Something we think about. And the reason for that, yes, we've got headline inflation pretty much in the middle of the target, but there are overs and unders around that. One of the unders, broadly speaking, is imported inflation, or inflation for imported goods and services, which has actually been falling. So we've been importing deflation recently, which is really pulling down those headline numbers. And in terms of overs, it's still that domestically generated inflation. So what so-called non-tradables inflation, or more sort of intuitively inflation created in the domestic New Zealand economy, it was still 4.9% in the last inflation data. We are confident that it is coming down. And we're confident that it will continue to come down and get to a place that is consistent with overall inflation being in the middle of that target band, around the 2% number, but we're not there yet. Essentially, that sort of imported deflation is giving us a bit of cover and a bit of confidence to allow that domestically generated inflation to do what's required. And we've also got what we call spare capacity in the economy. So demand, the economy's been subdued, GDP growth has been sort of low to no, even negative GDP growth over the last couple of years. So that's where the committee is confident that is going to continue to sort of weigh on that domestically generated inflation, leaving headline inflation sustainably at target.
So that non-tradable inflation, the domestic stuff, still up 4.something%, so quite a way over the 4.9%, nearly 5. So quite a way over the 1 to 3% target band. Although you don't target non-tradable inflation directly, you certainly in theory, this is the thing that the Reserve Bank can influence most directly.
Exactly.
So what within that 4.9%, what's responsible for the inflation? Any particular part of the economy, any particular organization, person, force that's taking us to 4.9%?
It is the usual suspects. We've been talking about them for a few statements now. So it is insurance premiums, sort of repricing of risk out the back of Cyclone Gabrielle. As we talked about in our recent financial stability review, inflation and insurance premium, it is easing, but it's still hanging in there. So there's still a bit of persistence in there. Other things are, rates, central government rates. There's also local government rates, I should say. There's also some central government charges, like road user charges, prescription charges are all coming through as well, just keeping it a bit higher than it normally is. Normally, we do get more inflation in the domestic economy than we do get coming across the border and import prices. So having domestically generated inflation around sort of 3% is consistent with headline inflation being in that 2% target range. So yeah, we are getting there.
Some of those prices you talk about in the domestic economy that have risen are what
Mm.
you'd call administered prices. So this is the government's decision or the council's decision. And some of them are in industries that are not very competitive. Home insurance, for example, the major player has more than 60% market share. Is there a concern here that you've got interest rates high and you can't really influence those administered or non-competitive prices? So do you worry that you're flogging a dead horse?
Yeah, like it's true. There's always going to be things that are going up in price in the economy. There's always going to be what we call relative price shifts. And actually, in this statement that we put out a couple of days ago, we sort of pointed to volatility, increased volatility in relative prices going forward. Trump having or President-elect Trump, I should say, having a trade war. That's going to send a big sort of price shifts through the global economy, and we can't pretend to influence that. We can't pretend that it's not going to happen. It absolutely is going to happen, and it has been happening over recent quarters and years. And the best thing we can do to sort of cope with that, climate change is another one. Cyclone Gabrielle put a sort of inflationary pulse through the economy, and the best thing we can do to cope with that is have inflation in the middle of the target band. So it's true that we can't influence those price changes directly. So to some extent, we've just got to accept them. So, headline inflation, it's being volatile, and it's probably going to be volatile going forward as well. But where monetary policy does work is if those relative price changes get into people's psyche, and if people think there's a bit of inflation around, it's probably going to be that way over the coming years, and it sort of becomes part of their economic behavior, becomes based on inflation above that 2% level. If inflation becomes generalized, kind of more widespread across the economy, that's when the central bank will start to lean into that with higher interest rates. To sort of just squeeze that out.
So just to understand that then, so let's say the government puts up fees and charges, and so do councils, and so do some sort of monopoly-style businesses, maybe airports, maybe regulated prices like those for electricity lines charges. Is there any way the Reserve Bank can look through those, so to speak, ignore them because they can't influence them in the way that the Reserve Bank sometimes looks through a price shock from, let's say, oil prices?
Oil prices is the classic example of a shock that we would look through. So yeah, the answer is yes. We can and do look through the initial impacts. I think, it's about getting comfortable with inflation, sort of using the whole band. Inflation, we've got a band for a reason, because sort of macroeconomic volatility is going to lead to inflation bouncing around. It's not always going to be just stuck at that 2% level. And it's actually efficient. It's sort of optimal for inflation to act as a shock absorber for some of those changes. It's part of the economy being able to sort of roll with the punches. And even having inflation outside of the band is just going to happen sometimes in the normal course of events, and we see that back through history. Surge in inflation that we've been living through the last 3 years or so is the exception. That's when those relative price shocks, which came at us from across the border, it started as sort of really high imported inflation for imported goods, and then it sort of got into the domestic economy, and that's when the bank started leaning in against it. So I don't know if it's like buckle up. It's a volatile economy, global economy out there. We're part of that. We're not going back to a really sort of, we used to call it the Great Moderation, when economists thought the business cycle was a thing of the past. Unfortunately, it was a fairly benign sort of period prior to the pandemic. I don't think we're going back there anytime soon.
Yeah, because it must be quite frustrating if you've got a mortgage, or you're in a business that depends on a floating business rate, and you see other parts of the economy put up their prices for their own reasons, simply because they can, because they're not subject to the disciplines of a market. And you have to pay the price for it in a way. You're being whacked over the head with a blunt instrument because the government or councils or insurers or the Commerce Commission have decided they're doing their thing for their own reason, which might be, for example, catching up on past underinvestment and effectively loading what is a capital cost into a price change for a day-to-day service.
Yeah, exactly. Like, I will make a couple of points with that. And firstly, New Zealand is a relatively expensive place. I don't think, you travel or if foreigners come to this country, there's a bit of shock about how much things cost here. And I do think that's partly related to the fact that many New Zealand markets, they're not what we would think of as competitive markets. There'd be a few players. We sort of lack big firms competing hard out with each other in many parts of the economy, which is, a big part of the recipe for productivity growth. And if productivity's improving, that can sort of flow to workers as higher wages, or to the owners of capital as higher returns, higher profits on their capital, or it can show up as lower prices for goods and services. And to my mind, the fact that New Zealand is relatively expensive reflects our poor productivity performance. And I do think, that makes New Zealand a tough gig. It's a tough place to live. I don't think the economy does. Yeah, I do think there's challenges in this space. I don't think it's incumbent on monetary policy to sort of operate in a different way. I don't think there's much that we can do about that. I think the solution to those types of problems, to the extent that there is a regulatory solution, and I do think there's things that we can do as a country to sort of combat that sort of lack of scale and competition in our markets. But it's not really the central bank. We have a blunt tool. Our mandate is to keep inflation low and stable, and that's our contribution to sort of long-run growth and prosperity. And I fully accept the point that there are, but again, there's not much that we as a central bank can do about changes in inequality across the economy. It's more for fiscal policy, tax policy, regulatory policy to get us to where we need to be in that world, in that space.
So just thinking about this year, if we're heading into Christmas, it's a chance to reflect. As recently as May the 22nd, the Reserve Bank was projecting, you couldn't call it promising or forecasting or
we wouldn't do that.
No. But, there was a view in the bank expressed in its monetary policy statement that interest rates were unlikely to fall this year and maybe wouldn't fall much next year. So that was May the 22nd. Yet we've had 125 basis points of cuts in the last 3 decisions.
We have.
And quite a significant shift in the view on inflation, growth, and interest rates. And I'm trying to work out what's changed in the interim that has forced the Reserve Bank to change.
Yep. Well, it's when the facts change. I changed my mind, sir. What do you do? So yeah, the economy has come a long way. Back at the beginning or earlier in the year, we were seeing more persistent inflation in the domestic economy. We were seeing it across the board. We didn't fully understand where it was coming from, but it certainly was a concern to the Monetary Policy Committee. And since that time, we've seen it significantly decline, which has been great and reassuring. So monetary policy is working. We have slowed down the economy. We have engineered a very soft patch in terms of New Zealand's economic growth, and it is working to bring those domestic inflationary pressures back under control. And as I was saying earlier, the other thing that's changed is imported inflation has fallen away more quickly than we were anticipating back then. So that's sort of given us a bit of cover to be doing what we're doing with interest rates over the last few months, even though that non-tradables, domestically generated inflation is still a bit too high. If we hadn't have had that deflationary pulse coming from offshore, we would be a little less relaxed about what's happening with domestic inflationary pressures. It's a lot easier. The Monetary Policy Committee, we talked about the context for inflation in New Zealand. That's changed a great deal since the beginning of the year, and it effectively has given us the confidence to cut rates while those domestic inflation pressures continue to decline.
The other big change in the last year has been a new government. It's been in place for a year now. It set out to tighten fiscal matters and has engineered a soft patch of its own through job losses and spending restraint, which it says is one of the reasons for lower inflation and one of the reasons why the official cash rate can be cut. How much of a role has that fiscal action played in the 125 basis points?
Yeah, so fiscal policy, the track, like in our projections, we're still using the track from the budget earlier in the year, which does have fiscal policy contracting as a share of the economy. Offsetting that, there have been increases in, as we were talking about earlier, administered fees. On balance, I'm just going to reflect what the governor said in our press conference the other day, that success has many parents, and he made the point that he's very pleased to no longer be an orphan. I think when inflation was going up and was well outside the band, it was a lot harder to find people that were sort of saying, yeah, well, we've been part of that. But I'm just pleased that we've got inflation back under control. I think it's a great way to end the year. Fully recognise that the reason for that is that a lot of New Zealanders have been doing it tough over the last couple of years. I think a debt of gratitude or acknowledgement of where we've been as a country in getting this done. Whether it's the government, I actually think just New Zealanders, Kiwis, have had a lot to do with our success in getting inflation back from 7.3% to 2.2%.
Just stepping back and looking more broadly at the last 2 or 3 years in the world and the role of inflation targeting and central banks. The world has had this inflation spike, and a whole bunch of governments have lost their jobs. The polls say, in large part, because of that inflation spike and the effects on a lot of workers. Did inflation targeting fail?
Like a couple of things there. I think the last few years, the fact that people have been changing governments and the cost of living crisis, inflation has definitely been part of that political calculus. It just shows how sort of pernicious inflation is. People really don't like inflation. The value of your dollar, something that you have a lot of confidence in, diminishing through time, is very negative, as many ex-political leaders could attest to. In terms of inflation targeting, I actually think the experience that we've just come through, or that we're sort of getting to the end of now, including previous economic shocks and crises such as the global financial crisis, I actually think the framework has stood up incredibly well. Yes, inflation did get out of control in the coming out of the pandemic. We've got a good understanding of why that occurred. But the framework of flexible inflation targeting has actually, got us back to a more or less an equilibrium in the product market, and with low and stable inflation. We've actually got a conference coming up next year on 35 years of inflation targeting. Inflation targeting as a monetary policy tool was invented right here at the Reserve Bank about 35 years ago. So we've got a conference looking back on it. So looking forward to sort of thinking more about it. But certainly my prior going into that is the framework has stood us in very good stead coming through these turbulent pandemic affected years in the macroeconomy.
Yeah, New Zealand's role as the granddaddy of inflation targeting is interesting, and there have been some criticisms. As recently as a few days ago in the Financial Times, a investment strategist called Ian Harnett argued that the reserve banks of the world shouldn't be focused or targeting inflation per se, the inflation rate. They should be targeting price levels, because one of the concerns here is that we've had this shock, 5, 6, 7% inflation for 2 or 3 years. Prices really jumped up, and now inflation's back down to 2% or so. But it's that shock. The level has risen up, and people are still feeling that level change. They're not so much focused on the percentage change right now. What do you think of that argument of, instead of targeting inflation per se, but you target some sort of price level, or at least some sort of trend line, so that you actually get the levels back down again to where they were?
Yeah, like that idea has been around for a while. There are alternatives out there to inflation targeting, like nominal GDP targeting or price level targeting. I'm very open to sort of exploring those. I think we should always keep an open mind to alternatives to the current sort of status quo. I would say, like, yes, the purchasing power of a Kiwi dollar, an Aussie dollar, the US dollar, has been eroded because of inflation over the past few years. Growth in nominal wages has been higher as a result. So there is a sort of catching up going on there, even though household expenses have gone up, household incomes have gone up in return, not to the same extent, but sort of not far off it. So we do sort of catch up. Yes, the value of a dollar shrunk, but we're earning more dollars per hour, not because our productivity's gone up, unfortunately, but because, to sort of keep up with costs. And my other kind of reaction is, having spent the last 2.5 years here at the bank fighting inflation hard out just to get the inflation rate down, it gives me the heebie-jeebies to think, what would we have to do to get deflation going in the economy to sort of get, the value of a dollar back up to where it was. I'm kind of interested in it from an academic perspective, from a sort of pragmatic policymaker's perspective. I think it would be quite challenging to target the price level as opposed to the rate of inflation.
Yes, wouldn't want to give you any more challenges, Paul. Thank you very much for your time. Paul Conway, the Chief Economist for the Reserve Bank of New Zealand, there, speaking on Friday, the 29th of November, a couple of days after the Reserve Bank's rate cut to 4.25%. Ka kite anō.